If you receive Social Security benefits right now, I need you to pause everything else for the next few minutes and stay with me, because here in June 2026, 3 specific financial updates may affect your monthly deposit, your tax situation, and your prescription medication costs. Many seniors I hear from either have not heard about all 3, or they have heard pieces of them without knowing the exact step they may need to take to receive the full benefit. I am not talking about vague ideas that might matter someday. I am talking about real amounts of money that may already be reflected in your account, may be available through a corrected tax filing, or may be reduced at the pharmacy because one number was never checked. My name is Masha. For more than 10 years, I have followed retirement benefits, senior tax rules, Medicare changes, and the financial programs that affect older Americans every year. And right now, in June 2026, these 3 updates together could make a meaningful difference for the right household, especially when they are understood and acted on correctly. Before we begin, I want to ask you something directly. Are you subscribed to this channel yet? If you are not, hit the subscribe button now and turn on the notification bell. Here is why that matters for you. Social Security rules, Medicare rules, and senior tax laws change often. When they do, you usually do not receive a simple letter explaining what changed, how it applies to your household, or what step you should consider next. This channel breaks down those changes in plain language as they happen. If you are not subscribed, the next update that could affect your money may pass by without you ever realizing it was available. Subscribe now, and let us walk through these 3 changes together. Here is what we are covering today. Change 1 involves the COLA increase that started in January. Many seniors saw that their actual deposit increase was smaller than the headline number. And for some seniors paying an IRMAA surcharge on Medicare right now, one official form may reduce that extra premium charge after Social Security reviews it. Change 2 involves a new senior tax deduction that applies to 2025 federal returns. If it was applied correctly, you may have already received the benefit. If it was missed, you may need an amended return to claim what you are eligible for. Change 3 matters especially right now in June. It involves prescription drug costs under Medicare Part D and the annual out-of-pocket cap that resets every January. Mid-year is the perfect time to check where you stand. 3 changes, 3 actions. Let us begin with your January deposit and the number many seniors never compared carefully enough. I want to ask you something directly, and if you can, actually do it right now. Pull up your January 2026 Social Security deposit on your phone, online banking, or paper bank statement. Then find your December 2025 deposit. Put those 2 numbers side by side. What is the difference? For many seniors, that difference was not what they expected. And here is why. The 2026 COLA was announced as 2.8%. For the average retired worker receiving around $2,015 per month before the adjustment, that meant a gross increase of about $56 per month. That was the number in the headlines. That was the number many people expected to see added to their check in January. But the Medicare Part B premium also increased at the same time, rising from $185 per month in 2025 to $202.90 in 2026. That is an increase of $17.90 per month. And because Part B premiums are usually deducted automatically from Social Security before the deposit reaches your bank account, that $17.90 came out before you saw the full COLA. For the average recipient, the net increase was closer to $38.10 per month, not the full $56. The Part B premium rose much faster than the COLA percentage itself. So while the headline said 2.8%, many seniors felt a smaller increase after Medicare premiums were deducted. Write down your 2 numbers now. January 2026 minus December 2025. That difference is your real net COLA. Keep that number in mind because it connects directly to what I am about to explain next. There is something important that many people do not fully understand when Medicare premiums rise. Social Security has a protection called the Hold Harmless provision. In simple terms, for many people who are enrolled in both Social Security and Medicare Part B and have the Part B premium deducted from their Social Security payment, The increase in the standard Part B premium cannot be larger than their dollar amount COLA increase. Put another way, the standard Medicare premium increase generally cannot cause the Social Security payment to drop below the amount received the month before, for people who qualify for that protection. For seniors with smaller benefits, if their 2.8% COLA produced less than the $17.90 Part B increase, this rule may have limited how much of the Part B increase was passed through to them. The way to check is simple. Compare January to December. If your deposit did not go down, even though your benefit is relatively small, the hold harmless rule may have helped protect your payment. If something looks confusing or you are not sure what happened, call Social Security at 1-800-077-21213 and ask whether the hold harmless provision affected your 2026 benefit. Now, for the seniors where this next part matters most, if you are currently paying IRMAA, the net impact of your COLA may have been even smaller, and for some people, one form may help reduce that extra charge going forward. Let me explain IRMAA for anyone who has not dealt with it before. IRMAA stands for Income-Related Monthly Adjustment Amount. It is an added charge that Medicare applies to Part B and Part D premiums when your income from 2 years earlier was above certain thresholds. For 2026, IRMAA is generally based on your 2024 tax return. The first IRMAA level begins when modified adjusted gross income is above the official threshold for your filing status, such as over $109,000 for many single filers and over $218,000 for many married couples filing jointly. The exact surcharge depends on your income tier, and higher tiers can increase premiums substantially. Here is the situation I want you to think about carefully. Your 2026 IRMAA charge is based on your 2024 income. If your 2024 income was higher because you were still working, had a one-time income event, sold property, received a large retirement distribution, or had another temporary income spike, you may be paying a higher Medicare premium today, based on a financial picture that no longer reflects your current life. That means money may be leaving your Social Security deposit each month because of income you are no longer receiving. Form SSA 44, available free from Social Security, lets you report certain life-changing events and request that Social Security use a more current income estimate when reviewing your IRMAA. Retirement is listed as a qualifying event. Work reduction is listed. Loss of pension income is listed. Death of a spouse is listed. Marriage, divorce, and certain other events may also qualify. If one of these events happened and your income dropped significantly, filing SSA 44 may reduce or remove an IRMAA surcharge after Social Security reviews and approves your request. Every month you delay may be another month paying a higher premium than necessary. When you file, gather documentation. For retirement, that may include a final pay stub, a letter from your former employer showing your separation date, or pension documents showing the change. For other qualifying events, bring records that show what happened and how your income changed. You can submit the form through Social Security according to their instructions, often by contacting your local office or mailing the paperwork securely. Processing times can vary, but many people see a decision within a few months. One more thing about IRMAA catches seniors every year. Some people assume that once they file a newer tax return showing lower income, Medicare will automatically reduce the current year's premium right away. That is not always how the 2-year look-back works. A 2025 return normally affects a later premium year, not necessarily the IRMAA you are paying right now. SSA 44 is the official path for requesting a faster review after a qualifying life-changing event. If you are paying IRMAA and your income has dropped since 2024 because of a qualifying event, do not ignore this form. Review it this week and contact Social Security if you need help. Change 2 is the one I hear about from seniors who filed their 2025 return and still do not know whether they received the benefit. If it was missed, an amended return may be needed. But before I go into that, I want to say something directly to you. The fact that you are still watching tells me something. Many people scroll past videos like this. They see the title, click, watch for 2 minutes, and move on. You stayed. That tells me you care about your finances and understand that knowing the rules can be the difference between keeping money in your pocket and leaving benefits unclaimed. So if you have not subscribed yet, do it now. Hit the button and turn on the bell, because Change 2 and Change 3 are exactly the kinds of updates many seniors discover months too late. You are here now. Stay subscribed so you do not miss the next one. Now, let us talk about the senior deduction. A recent federal tax law change created an additional deduction for many people aged 65 and older. For 2025 through 2028, eligible individuals who are 65 or older may qualify for an additional deduction of up to $6,000. For married couples where both spouses qualify, the potential combined amount may be up to $12,000. This applies to the 2025 federal tax return, which many seniors filed earlier this year. Here is what makes this deduction important. It is separate from the regular standard deduction and separate from the older additional standard deduction for age or blindness. You may be able to benefit whether you take the standard deduction or itemize, depending on your situation and the rules that apply to your return. It reduces taxable income, which can lower federal income tax. The deduction phases out at higher income levels, beginning around $75,000 of modified adjusted gross income for single filers and $150,000 for married couples filing jointly. If your income is below the phase-out level, the full deduction may be available. If your income is above the threshold but not too far above it, a partial deduction may still apply. Now here is the part I want to make very clear, because this is where tax information can easily become confusing. This deduction can reduce taxable income and federal tax, but it does not automatically change every tax calculation. It does not mean Social Security benefits disappear from the tax formula for everyone. Social Security taxation is based on provisional income, and that calculation follows its own rules. So do not assume that this deduction changes whether your Social Security is taxable unless your tax professional or tax software shows that result under current law. The practical calculation is still meaningful. A single senior in the 22% federal bracket who receives a $6,000 deduction could reduce federal tax by as much as $1,320. A married couple in that same bracket with a $12,000 deduction could reduce federal tax by as much as $2,640. If you are in a lower bracket, the savings may be smaller. If you owe little or no federal tax, the benefit may be limited. The key is that the deduction must be entered correctly. If it was not included, you may have paid more federal tax than necessary. That is why I want you to check your actual 2025 federal return. Not guess, not assume. Check it. Find the copy from your preparer, your tax software, your email, or your records. If you cannot find it, you may be able to request a transcript through irs.gov using the Get Transcript tool. Look for the senior deduction amount that applies to people 65 and older. It may appear in the deduction section or on an attached worksheet depending on the form layout and the software used. If you are single and over 65, look for up to $6,000. If you and your spouse both qualify, look for up to $12,000. If you see it and your income is within the limits, your preparer or software likely handled it correctly. If you do not see it, do not panic, but do ask questions. Call your preparer this week and ask specifically, was the additional senior deduction of up to $6,000 per qualifying person applied to my 2025 federal return? Do not ask only a general question about deductions. Ask that specific question. A preparer who is current on the 2025 tax law should be able to review your return and explain whether you qualified, whether it was included, and where it appears. If they are not familiar with it, ask them to check the current IRS guidance and review the return line by line. If the deduction was missed and you qualify, the usual correction is Form 1040-X, the amended U.S. individual income tax return. Filing an amended return can correct the original filing and may produce a refund if too much tax was paid. The amendment window for a 2025 return generally remains open for several years, so you have time. But I want to be direct. If you are owed money, waiting longer means waiting longer to receive it. If the amount is hundreds or thousands of dollars, that money can help with bills, medication, groceries, savings, or simply giving you more breathing room. There is another action connected to this deduction that can affect your monthly Social Security deposit going forward. If you are having federal income tax withheld from your Social Security benefit using Form W-4V, review your 2026 tax situation after accounting for the new senior deduction. For some seniors, the deduction may reduce their federal tax bill substantially. If your tax liability is lower but your withholding stayed the same, you may be sending more money to the IRS each month than necessary and waiting to get it back later as a refund. Talk with a qualified tax professional or use reliable tax software before changing withholding, but do not ignore it. A small monthly adjustment can make your current cash flow match your actual tax situation more closely. Change 3 is the one that matters most right now in June 2026. Before I explain it, I want you to do one thing. Think of one person you know who is on Medicare and takes regular prescription medications. It might be a parent, a spouse, a sibling, a neighbor, a friend from church, or someone in your community. Keep that person in mind as we go through this, because what I am about to explain has been active since January, and many seniors still do not understand how to check it. By the end of this section, you will know exactly what to tell them, and one conversation could help them avoid unnecessary prescription costs before December 31st. Now, the Medicare Part D out-of-pocket cap. Starting in 2025 and continuing in 2026, Medicare drug coverage includes a hard annual limit on what people pay out of pocket for covered Part D medications. In 2026, that limit is $2,100. Here is what that means in plain English. Once your true out-of-pocket spending for covered Part D drugs reaches $2,100 during the calendar year, your cost for covered Part D drugs should be zero for the rest of that calendar year. Not slightly reduced, not a small discount. Zero for covered Part D medications through December 31st, assuming the medication is covered by your plan and processed correctly. I want you to understand the importance of that number. Before this redesign, seniors taking expensive medications for conditions like cancer, diabetes, rheumatoid arthritis, multiple sclerosis, heart conditions, and other serious illnesses could face very high annual prescription costs. In 2024, the catastrophic coverage threshold was much higher. In 2025, the cap dropped to $2,000. In 2026, it is $2,100. This is one of the most important Medicare drug cost changes in years. You do not need to sign up separately for the cap. Your plan should track your covered Part D out-of-pocket spending automatically. When your qualifying spending reaches the limit, the pharmacy system should apply the zero-cost status for covered drugs for the rest of the year. But here is why I am discussing it now, in June, instead of only in January. The cap resets on January 1st every year. Every January, your spending starts over at zero and begins counting again toward the annual limit. People who take higher-cost medications, specialty drugs, or several regular prescriptions may reach the $2,100 threshold by spring or early summer. Right now, mid-year, many seniors have either already reached the cap or are getting close. And here is the problem I hear about too often. Some seniors cross the cap and still do not realize it. They may continue paying at the pharmacy because they never checked their year-to-date total, or because a claim was processed incorrectly. So I want you to do this today. Call your Part D plan using the member services phone number on the back of your insurance card. Ask for your year-to-date true out-of-pocket spending that counts toward the 2026 Part D cap. Ask for the exact number. Many plans also show this in the online member portal under Prescription History, Claims, or Benefit Summary. If you have already reached $2,100 in qualifying covered Part D spending, covered prescriptions filled after that point should cost you zero for the rest of 2026. If the pharmacy tries to charge you after you believe you crossed the cap, ask the pharmacist to recheck the claim and call your plan's member services line while you are there if possible. If you must pay to avoid missing medication, Save the receipt and contact the plan immediately to request a review and refund if the charge was incorrect. Do not wait months to question it. Handle it right away. If you have not reached the cap yet, but your regular medications may take you there before year-end, knowing your current number helps you plan accurately. It also tells you when to start watching pharmacy charges closely. Now, here is another piece many seniors have not connected to the cap. Medicare drug price negotiations have begun affecting certain high-cost medications in 2026. The first group of negotiated drugs includes widely used medications such as Eliquis for blood clots and atrial fibrillation, Jardiance for diabetes and heart failure, Xarelto for blood clot prevention, Farxiga for diabetes, heart failure, and kidney disease, Entresto for heart failure, Enbrel for rheumatoid arthritis and psoriasis, Imbruvica for certain blood cancers, Januvia for type 2 diabetes, Stelara for Crohn's disease and psoriasis, and certain insulin products including Fiasp and Novolog. If you take one of these medications, your costs may be different in 2026 than they were before, depending on your plan design, coverage, pharmacy, and where you are in the Part D benefit year. Lower negotiated prices can affect what plans pay and may affect what some patients pay at the counter. This does not mean every person will see the same dollar change, but it does mean you should check your plan's current price instead of assuming last year's cost still applies. The important point is this: your Part D out-of-pocket total and your prescription costs are connected. If the price of a medication changes, the timing of when you reach the $2,100 cap may also change. That is why checking the year-to-date number matters. One important distinction must be clear. The $2,100 cap applies to covered medications under Medicare Part D. Some medications are not billed under Part D. Drugs administered in a doctor's office, infusion center, hospital outpatient department, or clinical setting may be billed under Medicare Part B instead. That can include certain cancer treatments, infusions, injections, and biologic medications. Part B drugs follow different cost-sharing rules and do not count toward the Part D cap. If you receive medications through a medical facility or infusion center, ask whether each medication is billed under Part B or Part D. That answer changes how your costs are counted. Understanding which drugs fall under Part D and which fall under Part B gives you a much more accurate picture of your total annual out-of-pocket exposure. Before I move to the final checklist, I want to speak directly to one specific group of seniors watching right now. If your income is limited, there is a program through Social Security that many eligible seniors never apply for, and it may greatly reduce Medicare prescription drug costs. It is called Extra Help, also known as the Low-Income Subsidy. Extra Help can assist with Part D premiums, deductibles, and co-payments for qualifying people. Many people approved for Extra Help pay very low amounts for covered prescriptions. Some pay only a few dollars, depending on the medication and plan. Many seniors who qualify never apply because they assume the income or resource limits are lower than they really are, or because no one ever told them the program exists. If your income is modest, or you are not sure whether you qualify, make one call this week. Call Social Security at 1-800-772-1213 and ask specifically about Extra Help for Medicare prescription drug costs. You can also apply online at ssa.gov. June is a good time to apply because approval may help reduce costs for the second half of 2026 and put you in a better position for 2027. If you are unsure, apply anyway or ask Social Security to review your situation. There is no fee to apply, no obligation, and no downside to finding out. The only costly mistake is assuming you do not qualify without checking. Let me bring everything together now in the simplest way possible, because everything we covered today, the COLA reality, the IRMAA review, the senior deduction, and the Part D cap, comes down to 3 numbers. I want you to check all 3 before this week is over. Number 1, your January 2026 Social Security deposit minus your December 2025 Social Security deposit. That difference is your real net COLA. If it is smaller than you expected and you are paying IRMAA based on 2024 income that no longer reflects your current situation, Review Form SSA-44 at ssa.gov this week. Complete it only if you had a qualifying life-changing event and can document your current income. Then submit it to Social Security according to their instructions. If approved, the surcharge reduction may take effect after processing. Every month you wait may be another month of paying more than necessary. Number 2, your 2025 federal tax return. Find it today and look specifically for the additional senior deduction of up to $6,000 if you are single and age 65 or older, or up to $12,000 if you and your spouse both qualify. If it is there and your income is within the allowed range, you likely received the benefit. If it is not there, call your preparer this week and ask whether the additional senior deduction was applied correctly to your return. If it was missed and you qualify, ask about filing Form 1040-X. A refund will not automatically appear unless the return is corrected. Number 3, your year-to-date Part D out-of-pocket drug spending. Call your plan today using the member services number on your insurance card and ask for the exact amount that counts toward the $2,100 Part D cap. If you have already crossed the cap, covered Part D prescriptions for the rest of 2026 should cost $0 at the pharmacy counter. Confirm that at your next refill. If you have not reached the cap, keep tracking it and mark October 15th on your calendar, because that is when Medicare open enrollment begins. During open enrollment, compare 2027 plans at Medicare.gov using your exact medications, dosage, and preferred pharmacies. 3 numbers, about 30 minutes. That is all it takes to know where you stand and whether you need to take action right now. I want to close by saying something directly to you because it matters. Each of these changes requires awareness. The COLA arrived automatically, but an IRMAA reduction may require Form SSA-44 if you qualify. The senior deduction exists, but it helps only if it was properly claimed on your return. The Part D cap works automatically in the plan system, but you still need to know when you have reached it and confirm that your pharmacy charges are correct. These programs do not always send you a clear warning that says, you may be missing money. They do not always call you. They do not always explain your best next step. The system waits. The people who benefit most are not always the people with the most complicated finances. They are the people who know which numbers to check and take action before the opportunity passes. You watched this entire video, so you already know more than many seniors do. Now take the next step this week. Subscribe and turn on the notification bell if you have not already. Every month, Social Security, Medicare, and senior tax rules can change in ways that affect your income. This channel explains those updates in plain language before important deadlines pass. The next change could be the one that matters most for your situation, and you want to be here when it happens. Before you close this video, share it with one person you know who receives Social Security or uses Medicare. A parent, a sibling, a neighbor, someone from church, or a friend in your community. One share from you could help them find money they are entitled to keep, lower a cost they did not know could be reduced, or avoid paying more than necessary. I will see you in the next video.